Welcome to video 9A on ordinary and necessary business deductions. Here are the learning objectives for this chapter. So we're going to talk about what are the requirements to deduct a business expense. We're going to apply some limitations against those business expenses. There's a handful of special deductions and losses we're going to go through. And then we're going to talk about accounting methods and periods for tax purposes. So far we've covered constructive receipts. So we covered cash income, cash basis income. Now we're going to cover deductions for both cash and accrual and income for accrual as well. And then that's really what the next item says. Discuss the accounting methods available under the cash and accrual methods. Okay, let's get going. So business income, let's start with business income because I think sometimes people new to tax get a little bit confused about how all this works. So businesses can be organized in just a myriad of fashions, right? So a sole proprietor, which is when a business isn't organized at anything at all. There's simply a person and that person is operating as a business. And that doesn't mean a sole proprietor doesn't mean necessarily they don't have employees. It means really there's just one owner. You could organize as a corporation. And corporations very popular in the United States. You see a lot of public entities certainly set up as corporations. And then there are flow-through corporations or flow-through entities like partnerships and limited liability companies. And then a corporation can make an S election, which allows them to be treated as an S corporation. And we cover all that in greater detail later. We just want to talk about how these different businesses can be organized and then how we capture their income for tax purposes. So there's no question we know that choice of entity makes a difference. We talked about this back in the entity planning variable. But there are some tax accounting issues that cross over all types. So the rules can apply pretty much irrespective of what kind of entity you are. So first off, let's start with businesses don't have AGI. They don't have dependents. They don't have exemptions. Well, no one has exemptions anymore. And taxable income is really just gross income minus deductible business expenses. And there are many, many, many fewer parts to break down. But businesses can be considerably more complex than the typical individual's income. So we've seen this before. We looked at this earlier, I believe in this module. So we're not going to belabor this statement again. So this is Schedule 1 of a Form 1040. And the reason I'm showing you this, even though this is a business class, is because this is where business income gets picked up by the individual owners. Now remember that most entities are flow-through entities. And as a result, the income flows through to the owners. Well, owners are typically individuals eventually. Right? A corporation can own a corporation, but at some point, it's individuals that own that corporation even. So in any event, you'll see that here on line 12, business income attached Schedule C or CEZ, that's where sole proprietors ultimately report their income. So it's going to be first reported on a Schedule C, and then it's eventually going to come here to Schedule 1. And if you look down here on line 22, eventually Schedule 1 ends up on Form 1040, line 6, which is, of course, the individual income tax return. Line 17 picks up a number of other forms of business income, rental real estate, royalties, partnerships, S corporations, trusts, etc. And that first goes through a Schedule E and eventually lands on line 17. So here's what Schedule C looks like. It's profit or loss from business, sole proprietorship, right? It says it right at the top. And you can see that largely Part 1 is recording the gross income of the business, and you can see the deduction for cost of goods sold on line 4, as we know. And then Part 2 is all the deductible business expenses. So there's a number of expenses that get captured, and they're classified like you might see in financial statements. And the classification doesn't always match up with the way the business operates. But for the most part, you kind of classify things as you think they make sense. That amount, that net income, would eventually end up back on Schedule 1 and then on the 1040. Here's Schedule E, which recalls the supplemental schedule for a number of other types of business income. And here on the front page, This is income that comes from a rental real estate. So if you own rental property as an individual, not through some flow through, but you just own it, you would record the income and the expenses associated with the production of that income here. On the back page of Schedule E is where you pick up income or loss from partnerships and S corporations. Now, an LLC is either treated as a corporation for tax purposes or a partnership for tax purposes. And of course, that would end up in a different place depending on that choice. But if you treat it as a partnership, it's coming here through Part 2 to pick up whatever income. We don't really do estates and trusts in this class, but potentially you could own an estate or a trust and it would have flow-through income as well. All right, so notice that we talked about flow-through entities. Where did the earnings from corporate entities go? So let's say I own stock in a corporate entity. How do I pick up the income from that corporation? Well, remember, corporations are unique. First, they're subject to double taxation, right? So there's a layer of tax at the corporate level, and then there's a second layer of tax when the money is distributed. So corporate entities do not allocate income like flow-throughs do. Recall in some of our previous slides, or previous modules, chapters, we talked about how a partnership allocates income whether cash is allocated or not. Well, that's not true for a corporate entity. So for example, if you held shares in Amazon or Facebook, there's not some allocation that comes to you that you then pick up on your personal tax return. Instead, owners of corporations pick up income when the corporation distributes cash to them in the form of dividends. So you pick up corporate income through dividends, or if you just own and sell the stock, through ultimately the gain on the sale of whatever corporate stock you sell. Okay, so enough about income. Let's get to why we've come to this chapter, which is really about deductions. And the cool part is, right, so when it comes to personal expenses, limitations, right? The service has built a system that really does not permit us to take deductions for personal expenses. Now, again, if you take 503, you'll see that that's relaxed when there's things like itemized deductions and casualty losses. But for the most part, most expenses we incur are not deductible. Businesses are the opposite. 162 says, all ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business can be deducted. Section 212 covers something known as production of income, and we'll get into that before we're done with this module. But at least for now, it says you can deduct any ordinary and necessary expenses incurred for the production of income as well. So really, this is a wide, it just has to be ordinary and necessary. So it's very expansive. It is designed as big as an umbrella as gross income painted. That's the same with deductions. Business deductions largely are oriented in a way under the tax law that the interpretation is fairly liberal. When a business incurs an expense, they're largely eligible to deduct it. Okay, so the rules are the deduction must be directly connected to business activity, right? It must be a business expense. Ordinary and necessary means conducive to profit generation, and reasonable means not extravagant in amount. Now, it also says you're not allowed, is a different code section, but there's a code section that says you're not allowed to deduct an item that requires capitalization. And we get into that when we do the property chapter, which is chapter 10. But at least for now, note that something that requires capitalization, like an asset, right, property, plant, and equipment, of course you don't deduct those except through depreciation or amortization. All right, so let's talk about reasonable. Mike owns a business that employs his brother, Mark. Mark is paid $45,000 a year by Mike's business. In comparison, other employees that share the same responsibilities as Mark are only paid $30,000 per year. What is Mike's business deduction for employing Mark? Now look, he's paying Mark more. And the problem with this is Mike and Mark are related parties. And so a reasonable amount of compensating Mark is probably only $30,000 because that's what everyone else gets paid. There are, of course, opportunities to change that, right? So you might say, well, no, wait a second. Mark's worked here way longer, and so he's way more talented. right? But likely is the IRS is going to come in and say, no, 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 you can only deduct the 30,000. The extra 15 is some sort of gift that's going from Mike to Mark. Okay. Carolyn is 100% owner of a corporation. She ends up paying herself a bonus of all the net earnings of the corporation each year. Okay, let's think about that for a second. So she pays herself a bonus of all the earnings of the corporation each year. First off, is that reasonable? Is that how people are compensated? And the answer is generally no. So what might be the case here? Well, remember, a corporation pays tax, and then separately, the owner pays tax. So what has Carolyn done by paying herself a bonus of all the net earnings? She's zeroed out her corporate income, therefore eliminating the dual levels of taxation. Well, the tax law is not really comfortable with that. Okay, so maybe she decides, well, I'll just pay myself rent then, right? So maybe she owns the building that her business operates in, and instead she charges her own business rent. That's entirely plausible, but it really is supposed to be at market value. All right, well, that's not going to work. The IRS is going to come in and say, no, 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 you're charging your corporation amount in excess of market value. We're going to undo that deduction. Okay, well, she says, well, I'll loan my corporation money and I'll just charge them an interest rate that's extremely high, and I'll strip those earnings out. Well, all of these could be reconstrued as something called a constructive dividend, right? So remember, dividends are part two of the double taxation problem that corporations suffer. So what would happen is they'd be recharacterized as a dividend, and Carolyn would need to pay both corporate tax on whatever that income actually is, and then, of course, whatever the dividend she receives. Okay, so you can see that the previous example and this example both involve related party transactions, because related party transactions are simply notorious for the problems they create with respect to non-market value deductions. That brings us to the end of video 9A. Thanks for watching.